Don't look at your 401k today. The stock market is not reacting kindly to some new numbers. Seth Kaplan with Baird Wealth Management joins us now. The numbers today were kind of scary. The Consumer Price Index report came out showing inflation dipped a little bit. Not what investors were wanting, but not bad. I was looking at the numbers like, what am I missing here?
The inflation numbers weren't too far off expectations.
Right.
I think at this point, though, everyone's waiting to see what the Federal Reserve does.
Yeah.
There's a meeting next week. It's expected that they will lower rates, but it's still a question as for whether or not they'll lower rates 1/4% or 0.5%. So depending on how the inflation numbers came in,
right,
that largely was being viewed as being a prognosticator of that.
And we have the consumer spending today. Tomorrow we have producer spending, which the Fed likes to look at a little bit more with a little bit more scrutiny. So we could know more tomorrow whether that's good or bad. But this is still all going in the direction he wants. And in fact, we were talking before the break. Even mortgages are starting to come down as far as mortgage rates. They're not waiting for the Fed to do this. It's like they're thinking, oh, he's going to do this, so we're going to go ahead and bring down mortgage rates. That's a good thing, though, right?
Correct. The mortgage rates are more so priced based on the 10-year bond index as opposed to the shorter-term interest rates. The 10-year bond has come down quite a bit, as have short-term rates. So that has started to flow through into where mortgages are priced, and especially compared to 6 months ago, a year ago, it has started to come down.
When we talk about the other rates, too, for interest rates, buying cars, credit cards, for example, those, have they started to come down a little bit? I haven't been able to check as much. Or do we anticipate that more happening next week?
It's more so expected to flow through. It kind of trails, so it hasn't necessarily had as big of an impact yet, but it's expected to do so over time.
And we talk like, oh, the Fed's lowering interest rates. I'm going to wait till next week to do this or the month after. We're not talking huge amounts here. I mean, it's not like we're going to save thousands and thousands of dollars. It'll be better, but should we be planning on that, or should we be trying to focus on saving and riding the stock market during this tumultuous time? What's a good game plan here?
For anyone investing in stocks, that's a long-term place to keep money. So really, you shouldn't be reacting to the short-term noise. If you're putting money away for retirement, college savings for your kids, keep doing it. Don't react based on this. In regards to borrowing costs should come down, so it should be more favorable as time goes on.
Okay, so you could plan in other words, don't change your big plans. They should still be staying the same regardless of what the Fed says next week. We talk about job numbers. We talk about unemployment. Those numbers I'm trying to keep track of. The stock market's reacting wildly to this, but they don't look like terrible numbers. They still look like they're going in the direction. Are we missing something here, or is it just that, like we talked about, the Goldilocks effect? Things are so perfect right now. Any little hiccup has a big impact.
Yeah, it's more directional. We went through a time period where jobs were being added at a pretty robust pace.
Right.
They're still being added, but it's slowing down. So that kind of brings forth the question, is it going to slow down too much? We're not seeing massive layoffs yet. Right. So directionally speaking, things are still more solid than not. But a lot of it is just kind of the idea of where do we end up going from here?
Well, especially at this time of year, too, things get tumultuous, not just for the stock market. People are trying to plan their Christmas lists, how much they're going to have on holiday spendings and stuff like that. So a lot of families are like, ooh, what do I, there's a lot of uncertainty, right?
There's uncertainty, but as I tell my clients all the time, uncertainty is normal. So try and focus on what you can control, and beyond that, don't get too caught up in the short-term news.
What's the one thing that you want to get across to people when we talk about planning? We got the election come up. The stock market doesn't like uncertainty until we know who's in the White House. How should we be viewing the next 5 months, 6 months into next year?
From a financial planner perspective, I typically don't focus on the short term. So my message to people would be, think long term, think about kind of where you're trying to get to, and don't focus so much on the short term noise.
Good example. Again, when we talk about all the uncertainty right now, I keep looking, we do the numbers every day, and I'm like, And, it's hard not to get wrapped up in that and plan your finances accordingly. But don't do it. Take a little breather and look again at the long term. Is your wealth better than it was last year, 2 years ago, 5 years ago? Where are you going to plan to be in a year then?
And also put in perspective, for example, a day when the Dow Jones is down 400 points, 500 points, that relatively speaking is not even down 1%.
Right.
So when the Dow was at 10,000, it may have been a much bigger number.
Right.
In today's day and age, a move like 1%, 2%, that is not uncommon.
Yeah, we can just slough that off as no big deal.
Very much so.
Seth, thanks for your input. I love picking your brain on all of this stuff. I appreciate it. All right.